Hi, this is Anthony. Welcome back to my show. Remember, I'm just an amateur that's enthusiastic about investing in stocks. I think that most people, in the United States at least, should have a long-term, well-diversified portfolio. Now, when people do talk about stocks, and I talk about them a lot, but I'm not a investment advisor or anything like that, just somebody that's been looking at the stock market since 1987. A lot of people mention SPY, SPY, which is an S&P 500 ETF, exchange traded fund. So this is a mutual fund that's traded like a stock on the stock market. And I used to have a few shares of that, but doing more research, I found that VOOG, that's the symbol, which is Vanguard. It's a growth ETF that has the S&P 500 in it, or kind of uses that as the base. But it has a slightly higher rate of return, at least when the stock market's going up. So here's some information. Remember, the price is what it's traded at now. If this was started before this one, it's going to have a higher price. Don't think that this is, this price relative to that price means anything. This one tries to match the S&P 500. This one says S&P 500 growth. Okay, and so here is VOOG, and over the past year, it's up 24.94%, so almost 25%. The S&P 500 is up 16.15%. Certainly a respectable amount, but you're getting about 10% more, nearly 9% more than the S&P 500 in this case here. One month you can see the difference between SPY and VOOG. Year to date, so 9% there, 12% there. That's since January 2nd of 2025. 1 year it's up 18, and this one's up almost 27 according to this. 3 years, this is annualized, so not total, but up an annualized 17.18%. And this gives you about 2% more per year the last 3 years, annualized. And over the past 5 years, the difference is much less annualized, but remember, that extra 1 or 2% really adds up over a long holding, which I encourage people to have. Expense ratios, actually, according to this, is a little bit less for VOOG. That's kind of interesting. Things like spread really aren't important if you're holding long term. Okay. This the S&P 500 actually has 504 here. This one it doesn't show, and I'm not quite sure, but it may fluctuate day to day. They may, stocks that aren't doing well, that they don't think will do well in the near to moderate term, they may not have that the S&P 500 would have, and that, if they're successful in what they're doing, should give you a higher rate of return. Okay. And this just happens to be from ETF.com. I don't necessarily recommend them. They're just one that I found today. I mean, I've seen them before. This shows you what's in the two. So NVIDIA is the top holding here, and that's actually one of my top holdings. They have almost twice as much NVIDIA and VOOG than SPY. That's good when NVIDIA is going up, but if there's a turn down in the broad market, or one or more of these companies stumble for fundamental reasons, the drawdown or the decline in VOOG is probably going to be greater than SPY. So if you're holding for the short term, which I wouldn't recommend, SPY might be the way to go if you think that we're going to have a decline in the stock market. And quite frankly, we are due for a major pullback. The economy is due for a correction or a short recession at some point. Could happen this year, could happen next year, who knows? If anyone really knew, then they'd have a lot more money than they do. Okay, so Microsoft, a little bit less in VOOG. It's a slower grower than NVIDIA, although it's done well over time. Apple, roughly the same, or yeah, roughly the same. A little bit less Apple and VOOG. Meta Platforms, 5% there. About twice as much as SPY. So anyway, you can go through this. I'm not going to read all of these off for you. So again, do your own research. Don't watch this video and get convinced because of anything I say that you should go into one or the other. Even if you're in SPY and you didn't go into this, you're not probably going to make as much long term as if you were in VOOG, but you're still going to be a lot better than just keeping your money in cash. So it's better to be invested in something that's fairly good, even if it's not necessarily the very best thing that you could put it in for the long term. Again, this is going to give you a well-balanced portfolio. You're getting 504 stocks there. I'm not quite sure how many you're getting here, but still hundreds of stocks there. So that's better than nothing. So what are your thoughts? Remember, I'm not a financial advisor, just somebody who's very interested in the stock market, and lately I've done pretty well. I encourage you, if you haven't already, please do hit subscribe. Hopefully you'll hit like on this. Leave a comment. I read all the comments, and eventually I get around to responding to them individually. Thank you so much.